Hi everyone, welcome back to my channel. In this video, we're going to calculate the cash flow from operations using both the direct and the indirect method. Relevant information is being given here, so we're going to use that in doing our calculations. To calculate the cash collected from customers, we start with revenue, which represents our sales. And we're going to subtract any increase in accounts receivable. Why do we subtract increase in accounts receivable? Because part of the sales that we did, we never received the cash for it. Okay, part of the sales that we did, we never received the cash for it. So the actual cash collection is going to be 500,000 minus the increase in accounts receivable. Cash paid to suppliers, we started with the cost of goods sold, which represents the purchases that we made from our suppliers. As we can see, the balance of our inventory has gone up, which means that we invested into our inventory, and hence we made those purchases which led to cash outflow to our suppliers. So we're going to add increases to our inventory. So we're going to do the ending balance of the inventory minus the beginning balance. And our accounts payable has gone up. Accounts payable represents the money that we owe to our suppliers for the purchases that we have made from them on credit. Since accounts payable has gone up, it means that we have not yet paid our suppliers for the purchase that we made from them, so it's a source of cash for us. Hence, we're going to do a negative adjustment here because this money has not left our bank account yet. Cash paid for salaries is simple plug-in. Cash paid for taxes is 15,000. So cash flow from operations is going to be the cash collected from customers minus the sum of these three line items, which gives us cash from operations equal to $200,000. The indirect method of calculating cash from operations, I have talked theoretically about the direct and the indirect method in one of my previous videos, so please do watch that if you're struggling with internalizing these concepts. We start with our net income and we add back any non-cash charges such as depreciation, and we subtract the change in net working capital. The net working capital is defined as current operating assets minus current operating liabilities. As you can see, the current operating assets in this example are accounts receivable and inventory. Current operating liability is accounts payable. So we'll start with the net income, which is 210,000. We add back depreciation. So depreciation here is 15,000. The change in net working capital, again, it's account receivable plus accounts payable. Accounts receivable plus inventory minus accounts payable in this case. It's current operating assets minus current operating liabilities. So we're going to open the parentheses. I'm going to look at the beginning balance plus the beginning balance of inventory minus the accounts payable beginning balance, and subtract it, open parentheses, accounts receivable ending balance plus inventory ending balance, and subtract accounts payable ending balance. Okay, and I'm just gonna, we can use the auto sum function here, and happens to be the same. Hope you guys like this video, a simple illustration of how both methods work, either the direct or the indirect. In practice, firms use indirect method because of the ease of using the information, and a lot of accrual data is already available with the firm. Direct method is what is preferred by accounting bodies, but most of the firms that we do analyze prepare the cash flow from operations using the indirect method. This direct or indirect method of preparing cash flow statement only applies to the cash flow from operations, whereas the treatment for the cash flow investing and financing remains the same. Hope you like this video and see you for the next one.